this dollar difference times the tax rate gives us our change in DTL, just like the difference here of 13.333 times our tax rate gives us 4. So anytime we deal with the difference in dollars times the tax rate, that gives us our DTL. So 100 minus 80 is 20, times 30% is 6. That's how we get our DTL there. 25 minus 18.333 is 6.66666. Times 0.3 gives us our 2. That's our change. Our difference there is our change. And then 110 minus 96.66666 is 13.33333 times 0.3 gives us our 4, and that 4 is our ending DTL. So anytime here I'm saying beginning minus beginning times tax rate gives me my beginning DTL. Change minus change times the tax rate gives me my change in DTL. Ending minus ending times the tax rate gives me my ending DTL. So that's kind of how that's set up. Pretty cool. Now let's go on to year 2. So ending in year 1 is beginning in year 2. We have those two answers. It tells us that we purchased something worth $70 and we had no sales, which is nice. And then book tells us that our ending balance is 140, and that's on the back side of this worksheet, the one-page worksheet that we have. And I don't have it on the computer as far as I know. Let me look for a second. Oh, I do actually have it on the computer. It's right here. Ending amount 140. So we got that from there, gave it to us. We can then solve for our depreciation, which was $40. And on the front, it tells us what our tax depreciation was deducted for salt. It tells us 56.67. So we can take all of this information and solve for our ending balance of 110 in tax. And we already solved everything for book. So if we know that there's a $30 difference here for tax, we have a DTL of 9. 30 times 0.3 is 9. So what are our DTL amounts? Well, we have our 4 that we had at the beginning. We have our 9 that we have at the end. And $5 is the plug. Or you could say, what is the difference between these two? It's 16.6666666. And if you multiply that by 0.3, you get 5. So each time you can either plug one of the DTL amounts, or you can look at the changes. If the change is a certain amount times the tax rate, that will give you the change in DTL. The ending amount is 30 times 0.3 gives us our 9. So the change here of 16.666 times 0.3 would give us our 5. Hopefully that makes a little bit of sense. Sister Larson has a little video on that as well. So we know that our DTL changed by 5. So we can come over here to our DTL amount and we can say deferred tax amount -5 because we're increasing our DTL and therefore having a deferred tax expense. Remember, if you credit the DTL, you debit the deferred tax expense. Now let's come over here and reconcile our book to tax income. It starts with 40. How do we know that? Because before taxes, our revenue minus all of our expenses equals 40. You can do the math over there and you get that. The depreciation, we depreciated 16.67 more. 40 minus the 56.67, we depreciated 16 more, and our taxable income then is 23.33. And then I did a little round up thing because I don't want to deal with 6.99 whatever. So current tax expense would be 7. So we put that in here, -7, and we can solve for our income. Sum all of these up, and we get 28. So the income that we have from S, the journal entry would be income of 28 and increase our investment of 28, right? That makes sense. That's one of the journal entries. Now it tells us in the problem that we paid $15 dividends. So here's our entry there. And then our amortization expense, you know, is 14 because it's the same as it's always been. It's the -20 plus 6. So let's jump back over here and record that amount. These are our journal entries that we had. And we can record 28 minus 14 gives us income from the sub of $14. So now we have this amount, and we can solve for our book to tax difference here. So that was the tax provision. That was question number 1, tax provision for SALT. We have -7 and -5. We solved for the net income. We did the journal entries. This is now not part of the provision. This is the next little part. I think this is actually asked for in question 4. So we jumped the gun a little bit, but that's okay. That's kind of the order that you can do it in. And you're looking for these two parts. So current and deferred. Well, let's start with the way we did it with SALT. Let's figure out the difference in depreciation, because we're going to need that to reconcile the two amounts. Let's start with deferred, and then we'll go into current. Pepper's books, 250, 200. We figured that out at the first part. 20 and 20, we purchased amounts. We purchased equipment. We didn't sell any, so those are 0. We were told what the ending balance was, and we were told that the DTL ended at 12. And I believe that was right here, 12. So we could then solve for the tax basis, ending balance, and then we can solve both of the depreciation amounts, and it was a difference of 10. Now our DTL was 15 and our DTL was 12, so we know that it had to decrease by 3. We could also have said that we took more depreciation for book than we did for tax, $10 worth. 10 times 0.3 is 3. And if we took more for books than tax, our DTL went down. So you can solve for that 3 two different ways. You can solve for it based on the DTL amounts, or you can solve for it based on the change in depreciation that you're adding to or taking away from your DTL by this amount in this period. Now let's jump down to year 2. The ending balance of year 1 becomes the beginning balance of year 2 for both of them. We're told that we purchased equipment for $250 and we used stock. So we'll deal with that in a bit, but just know that it wasn't cash, it was stock. We sold, now this part, we did sell equipment. And these two numbers are different. It tells us that the book value of the equipment we sold was $35, but the tax basis was $25. So we put those in as different numbers. We're told what the ending balance was for books right over here, 380, boom. So we take that amount, solve for the $75 depreciation, and then we're told what the tax depreciation was of 105. We know that 200, 250, 25, 105, we can solve for the 320. That's the simple T account stuff. And if we have the 320 and the 380, that's a difference of 60. 60 times 0.3 is 18. And we took more for book, or sorry, our basis for tax is greater. Dang, I'm messing up, sorry. Our basis for tax is lower than it is for book. Therefore, this 18 is the DTL. And so 18, 12, we can solve for this, it's 6. Now, there's a little bit of confusion there because what we had said before of this 3, we can solve for it both ways. This $6, you can just plug. 12, boom. 18, boom. You get the 6. This 9 and 3 is a little bit confusing because we had this sale, and I want to explain what that means. The $9 comes from the change in 75 to 105. If we were to do it like we did here, the $10 change times 0.3 is 3. The $30 change times 0.3 is 9. So where's this other 3? And that is actually pretty cool. We're going to jump over here and talk about that in just a minute. Book income, 440. We had to solve for their net income, the amount that we get from them to get that. 2,300 plus 14 minus those two amounts gives us 440. You can check that in your calculator, pause this if you want. Depreciation, we know the difference was 30. We took more for tax than we did for book, so we have a $30 deduction there. And then bad debt, we're told that they recorded bad debt expense of 15 but only wrote off 5. So we have to increase our amount by 10 as a temporary difference, and we'll create a DTA for that in just a bit. Meals, we deducted 100. We can only do half for tax, so we have to add back that 50. Now this is that fun part. This is where the 3 comes in. We had recorded a sale of equipment. We sold it for $30. Our book basis was 35. So we had a book loss of $5. But we have to increase our tax amount because that loss is not actually real. And likewise, we had a tax basis of 25 when we sold it for 30. So we had a tax gain of $5. And that's not real either. So those two amounts we have to get rid of. And in this case, we are getting rid of the loss and we are getting rid of that gain. So this $5 and $5 equals $10. So that's the other difference. And it's with the depreciation I have over here. 5 plus 5 is 10 times 0.3 is $3. So that amount right here, the $3, that's where that comes from. 9 minus 3, or the difference of, let me drag over here, the difference of 30 times 0.3, and the difference of 10 times 0.3. So 9 minus 3 equals 6. So that's kind of cool, a little bit of how that all works together. I think I got a little ahead of myself saying that these were not real. I want to clarify that. On our books, we've recorded a loss of 5. That did not happen for tax, so we have to add it back. But we did get a gain of 5 that was never recorded in our books. And so this tax gain was real in terms of tax, so we have to add it in because we're taxed on that gain. The book amount, that gave us a loss. Tax does not care. It's not a real loss, so we get rid of it. And the tax gain, for tax purposes, we are taxed on that gain, so we had to add it back. So that's why this 5 and this 5 exist. Now, this amount had to do with depreciation. We were getting rid of, when we had $25 and $35 of basis, when we figured out both of the gains and the losses, we had depreciation in there, too much for tax and not enough for book. And so when we add those two together, that's how we get the 10. It's as if we were debiting that depreciation amount. So this difference in the credits right here of 30 is going to be adding to our DTL, and getting rid of that depreciation amount of 10 is going to be decreasing our DTL. So that's as if we put a 9 and a 3 here, or we can just net it and put 6. So hopefully that kind of makes a little bit more sense.